couple slides because Anthony Lewis just did a fantastic job, although I did an actual flower instead of the picture that he had. Okay, well, so let's think about the desirability of why a central bank would want to think further and issue something beyond currency that you have in your wallet. So this is the Riksbank from their Riksbank report. That's the oldest central bank in the world, the Swedish central bank. And they think that having an e-krona, an electronic digital currency issued by the central bank, would be great. Why? Because there's a worry in Sweden that most of cash is gone. There is no cash in the economy. And what remains is one single payment system, basically, that runs on one single backbone called bank gyro. All payment systems go through the one backbone. And if you think about this, this is massive, what we call in the industry, single point of failure. If bank gyro doesn't work, you don't even have cash to make transactions. So we'll be back to milk coin. And that's why, conceivably, in Sweden, as a backup to the citizens in that country, the central bank would offer you a alternative electronic payment rail that runs on totally separate technology. Now, but really, if you think about this, is this any better than your current system? No, it doesn't have to be. It just has to be a different system to succeed, right? But in other economies, say maybe in Korea, you don't have this problem. You have many providers, many backbones for electronic payments today. So why would the Korean government want to consider issuing a central bank digital currency at all? Because they don't even have the excuse of a backup system. Now, well, certainly some central bankers think then issuing retail central bank digital currency is a bad idea. So Ravi Menon, who's the managing director or the governor of the central bank in Singapore, says there's a problem. He thinks it's not a great idea. With a bank run, who's going to extend credit to the economy? Mark Carney from the Bank of England says a similar thing, which is that credit allocation by his central bankers across the whole economy is not a good idea. Now, let's step back and see why this is a worry for central bankers, why they're unwilling to do this. So let's look at a bank in Singapore. This is the balance sheet of one of the banks. The color doesn't mean anything, by the way. So if you look at the top there, that's the liabilities, and assets are below. Okay. Now, if you look at less than 7 days, that's money they owe to you as a depositor that they have to return to you within 7 days. These are sight deposits. And then below here, you look at loans and advances to customers. Look over there. So people owe them money, and they're going to return that within the next 7 days. The amount that people will return to them is about $27.8 billion. Wait, think about that. There's a problem here, right? So this is a classic borrow short, lend long issue that banks do. This is what banks do. Now, if you think about this particular bank and how its balance sheet is structured, it means that if suddenly everyone who's their customer, the retail customers, takes out their bank deposits and moves it to the central bank as central bank digital currency, what happens? It needs to, all that money, $239 billion could disappear immediately, and it needs to replace that. But the money that's coming in the next 7 days is only $27.8 billion. It needs to somehow go out to the market and borrow. Who is willing to lend money to that bank in an emergency like that? That's the role of the lender of last resort in any country, which is the central bank's role. No, so this boils down to what you saw in the previous slide, which is that there's a credit allocation problem. The central bank has to decide Do I want to lend that shortfall to this bank so that I keep it alive? Now, post financial crisis, back to that question again, we're back to this. Have we, by introducing central bank digital currency, just reintroduced the same problem that we had, which is too big to fail in the first place? Have we reintroduced the same triggers for the financial crisis, which is that the Federal Reserve or central banks bail out all the banks? Do we need the bank? So that's a policy question right now. Do you need the bank? Yes, arguably, because the bank has lent out all that money to finance mortgage loans. Who's going to finance your mortgage loan then? Do you want the government of Korea to step in, basically for taxpayers yourselves, to finance all the loans that are outstanding in the economy? That's the uneasiness that central bankers have. So what if we don't have a central bank issue this money instead? We get a commercial bank. So Anthony Lewis talked a little bit about that. But so let's see. Let's just come here, which is, can you find a commercial bank who's willing to issue a central bank digital currency, one for one, fully reserved? And I would argue no. The problem is the rate of return that most banks need to satisfy their shareholders are too high for you to issue a central bank digital currency. Why? Because when you issue a central bank digital currency, you're promising one-for-one backing, fully reserved, which means that all the money sits in the central bank. Unless the central bank is paying you interest on the money that you're putting there, so the bank on your behalf puts the money into the central bank. Unless they're paying high interest, the bank can't offer you interest at all. In fact, the bank isn't making any money off that. It isn't able to make loans off that. So it's not able to make a return on equity, right? Because under Basel rules, the banks have to, it's on their balance sheet. So they have to set aside equity for that, capital for that, right? And that's a waste of capital, basically. So arguably, commercial banks, there is no good reason for a commercial bank to do this. So what's the bad news here, or the good news? The good news is that commercial banks won't do it because they can't afford to. Then it boils down to another realization, which is that you need subsidies. Ultimately, we're back to taxpayer subsidies. So the central bank has to, or the government of that country has to subsidize the scheme, or no commercial bank will ever touch this. So now let's go back a couple of slides. So fundamentally, I think to reiterate some of what Anthony Lewis said earlier, the question is not whether central bank digital currencies are good for central banks. I think the answer is quite clear. It's not very good for them. In fact, sometimes it's very bad. But why do we keep obsessing about central bank digital currency then? Why do we keep obsessing about having a stable coin? Well, because all our use cases, to fulfill the promise of smart contracts, you need a stable coin. Basically, you need something that has no credit risk, that has assured liquidity, right? So I could get a commercial bank to issue a coin that is fully backed, but that may have no credit risk, but does it have other risks? Yes, it has liquidity risk because the commercial bank cannot print new money unless it finds more money to put inside that pool that backs that issuance. So that's why a central bank needs to do this. And we need to find a central bank to do this because for your smart contract to deal with deterministically, atomically, with swaps and fulfill all the promises of smart contracts, we need to have assets that are fully, really on-chain. And that's why, back to the tokenization issue again, we are trying to tokenize all these assets, including central bank digital currency. Because central banks don't need central bank digital currency. The truth is, the crypto economy needs central bank digital currency. So our efforts are really to drive that promise. You have to go to a central bank and say, there's no way you can persuade them to issue a central bank digital currency on its own merits. You have to go to a central bank and say, I want you to help me issue a central bank digital currency because there are all these benefits that come with using smart contracts for XYZ use cases. And fundamentally, I like this picture a little bit, not just because I drew it, but where are we going with all this, right? So the internet in the past, so Swift, what is Swift? Swift is a message transfer service. It's a dumb pipe in between with standards for smart devices on both ends to deal with things. So when you send money through Swift, you're not sending money through Swift at all. You're sending messages about money. You're sending messages about how to transfer that money. And so Swift is not responsible when you have money laundering issues. The banks who are users of Swift at the endpoints are supposed to do all that. Whereas what we're building out today for tomorrow are smart contracts. What we're building out is on a blockchain, most of the time, say Bitcoin, is something where the message, so back to Anthony's point about sending money is sending an email. You have the message with the settlement happening simultaneously on the same chain. So actually the pipe is now theoretically responsible for settlement, which means that you can't take the same excuse that you did in the past, which is to say, I'm just an innocent transfer of messages. If you operate this network, if you own a node on this network, hypothetically, in fact practically, you are responsible for what happens there. So if a terrorist were to use Bitcoin for financing, because the settlement happens with the messaging, I guess we are all complicit with that bad activity. And so I leave you with the thought that go home and think about this. What is your personal risk appetite? What is your personal view about your responsibility as a user of this next generation of value, the Internet of Value? What do you think you want to do personally to help to make this a reality?